Hello and welcome to this video. In this video, we are going to talk about HKS 16, property, plant, and equipment. The purpose of this video is to provide a revision on this standard, HKS 16, that is on property, plant, and equipment for your exam preparations or for any other reason. So this is just a summary of the standard, whereas the standard is very long. So let's get started with what the standard is about. So first of all, we are going to look at what's covered in this standard and what's not covered in this standard. What is the recognition criteria under the standard? The measurement principle, how do you measure property, plant, and equipment on the recognition and then after recognition? We will talk about depreciation and then few disclosures. So let's look into the scope of the standard. The standard applies to accounting for property, plant, and equipment, commonly known as PPE. The short form is PPE. The standard does not apply to the following: property, plant, and equipment classified under HKFRS 5. If you know, this is a standard which talks about assets held for sale. So I've written a short form here, HFS, which is actually the abbreviation for held for sale. So property, plant, and equipment, which is classified under this standard HKFRS 5, is not classified under HKAS 16. Then biological assets, which are categorized under or covered under HKS 41, exploration and evaluation of assets, plus the mineral rights and mineral reserves such as oil and natural gas. So for example, if you're appearing for any professional accounting exam and you see somewhere in the exam that they're talking about mineral rights or mineral reserves, so you may want to be a little careful before applying HKS 16 because this may not be covered in HKS 16. So you have to be really careful when reading those questions because HKS 16 is very much specific to property, plant, and equipment only. Let's look at the recognition criteria under HKS 16. So HKS 16, the recognition criteria, and let's see what you can recognize under HKS 16 or what an entity can recognize under HKS 16. The cost of an item of a PPE, so cost of a PPE shall be recognized as an asset, can only be recognized as an asset if these two conditions are met. So if these, you see there's an and here. So both of these conditions must be satisfied. Both of these conditions must be satisfied before the entity can recognize that PPE or as an asset on their statement of financial position. So what are these two criteria? So these two criteria are: it is probable that future economic benefit associated with the item will flow to the entity, and the cost of the item can be measured reliably. Right, so two things: the future economic benefit must flow to the entity. The future economic benefit should flow to the entity, and the cost of that PPE that you want to recognize, that an entity wants to recognize, should be measured reliably. Plus, there are always these low value items such as spare parts, very small, tiny bit cheap stuff that may not be necessarily covered under HKS 16, but they may be aggregated together to be recognized as PPE. But then here you have to exercise judgment. This area is where you will be exercising judgment. The key part here is this is the key part. You must remember these two criteria that must be satisfied to recognize the asset on your statement of financial position. So let's move on ahead and see what is the measurement at recognition. So what would be included at the recognition? What would be the cost of an item of PPE? How would you calculate the cost of PPE, in other words? Right, so that will include these three components here. The very basic thing, of course, the purchase price will be included, any import duties, non-refundable purchase taxes, after deducting trade discounts and rebates. So it has to be a net amount, right? It has to be a net amount. So if you have if you have received any trade discounts or anything like that on your purchase of PPE, you have to deduct that. The second consideration that you have to make is any cost directly attributable. So these terms here used in the standards are very important. So again, if you're writing any accounting professional exams, you must be using appropriate terms. You don't want to deviate from the accounting terms, because accounting is a language. So, you have to speak certain language. So these terms here are very important. This term, this phrase, cost directly attributable, is important here. So any cost directly attributable to bringing the assets to the location and condition necessary for it to be capable of operating in manner intended by management. So any cost, for example, first time installation cost, installation cost, that would be a cost directly attributable to the PPE. The company may not be able to use the machinery or any equipment that they have purchased without proper installation, right? So that would be a cost directly attributable to the PPE, and this would be recognized in the cost of the asset. This would be capitalized in the cost of the asset. The third point here is the initial estimate of the cost of dismantling and removing the item and restoring the site on which it is located. The obligation for which an entity incurs either when the item is acquired or as a consequence of having used the item during a particular period for purposes other than to produce inventories during that period. So basically, if you see this point has been tested a lot in accounting professional exams. They would usually give you a dollar number for cost of dismantling, and they can ask you whether this cost would be, how would this cost be treated, or they will ask you the accounting treatment of this cost, and this is the accounting treatment of this cost, right? Here, this is the accounting treatment of this cost. This cost will be capitalized in the cost of the asset, and it's only an estimate. It's only an estimate, because the actual cost, you will know the actual cost once you incur that cost, right? But initially, because accountants are conservative, they are prudent. Prudence concept says that losses incurred, even in the future, you have to recognize them beforehand, even if they are not incurred yet. Whereas for the revenue, unless you have earned the revenue, you cannot recognize the revenue. That's the basic accounting principle. So these would be the three types of costs that you would be capitalizing or recognizing in the cost of the PPE. That is the purchase price here, any directly attributable cost, any costs that are directly attributable, and initial estimate of cost of dismantling and removing the item, right? So these would be the three types of costs that you would take into consideration when recognizing an asset on your statement of financial position. So these are taken actually from the standard by itself. So these are costs which are not included in the PPE. Examples of costs which are not included in the PPE, they would be included in actually P&L. They would be expense. So for example, administration and other general overhead costs, this is an expense. This would go into P&L. Cost of conducting business in a new location or with a new class of customer, right? Including cost of staff training. This is again a P&L item, not an item which will actually be recognized as an asset. And for these to be recognized as an asset, you should look at the recognition criteria, right? So they do not meet the recognition criteria that has been outlined by the standard itself. So you can always go back and see what is the recognition criteria. So when to stop recognizing cost as an asset. So of course, you cannot continuously, as a business cannot continuously capitalize all of the cost. There's a difference between capital expenditure. There is a difference between capital expenditure and revenue expenditure. Right? So not all the cost would be recognized as an asset. And we have seen examples of such cost in the previous slide, right? So when do you stop? When as an entity will you stop to recognize the cost of an asset? And the cost that will cease when the item is in the location and condition necessary for it to be capable of operating in the manner intended by the management. So basically entity stops the capitalization of cost when the asset is ready. So when the asset is ready to be used by the management as intended, the company has to stop recognizing any other cost incurred after that criteria has been met. So you will stop once the asset is ready. No further cost will be capitalized unless any other thing comes up. Now let's look into measurement after recognition. So how would you treat the asset after recognition? Right, so as we know, there are only two models under HKAS 16. The company can either use cost model or they can either use revaluation model. So under cost model is very simple. You take the cost, you minus any accumulated depreciation and any accumulated impairment loss. It is exactly the same in revaluation. The only difference is that this is based on fair value of the asset each year. So every year, the company is going to revalue the asset. Every year, entity has to perform revaluation. But of course, you deduct any depreciation and subsequent impairment losses. So these are like few items that are important for revaluation. And then for item 2 and item 3, this is a little wordy, therefore I would have an example in the next slide, and hopefully this will clear up the words over there. The first thing is that revaluations shall be made with sufficient regularity. As I said, this is because of consistency. Right? To ensure that carrying amount does not differ materially. So if the entity has decided to report its asset or PPE on a revaluation basis, then they have to do the revaluation at the same time each and every year. Right, so let's look into point 2 and point 3 as well in summary, and then we will move on to the example in the next slide. So what does it say in point 2? If the assets carrying amount is increased, so if it goes upward, so let's say there's an increase in the fair value from year 1 to year 2, the increase shall be recognized in OCI. So it will not go to P&L, it will be recognized in OCI and accumulated in equity under the heading of revaluation surplus. So this would be the account name. So the increase will go to the revaluation surplus. However, the increase shall be recognized in profit or loss to the extent that it reverses a revaluation decrease of the same asset previously recognized in profit or loss. Now, so for this one, I have an example in the next slide. This will clear up. It's basically saying that any loss that has been incurred before can be removed first, and then the remaining gain can go to OCI. The point 3 is basically when carrying amount decreases. So this is downward valuation. So this is downward revaluation. Any decrease shall be recognized in profit or loss. However, the decrease shall be recognized in OCI to the extent of any credit balance. So let's say if you have any positive balance, first you will remove that positive balance from OCI, and then the remainder will go to the P&L. That's what this whole paragraph is trying to say. So first you remove any positive balance from OCI, and then remaining loss goes to P&L. I will come to this. I will come to this as an example shown in the next slide. So let's move to the next slide and look at the example. So this is an example, right? So I have these numbers here with, and I'm assuming that the carrying value of the asset is after depreciation. Otherwise, this example would be a little more complicated. But in the exam, if you're writing any professional accounting exams, you have to be careful because there would be depreciation as well. Of course, no matter which model is entity using, either cost model or revaluation model for subsequent measurement, there is going to be depreciation as well. So let's look at the example. On April 2000, the company has an asset with a carrying value of 100,000. Then on 1st April 2001, the asset has a carrying value of 120,000. So what happened in 1 year? The asset increased in valuation by $20,000. Then from April 2001 to April 2002, the assets value decreased by 25,000. So assets value decreased by 25,000. And then from April 2002 to April 2003, the asset value went up by 15,000. So now we are going to look at what would be the general entries at each of the year end. Let's say the year end is April 2000. So you see there's a consistency between the dates as well. So the measurement, the revaluation exercise is going to take place in April each year. So in April 2001, the asset went up by 20,000. So of course, if you by now you should be very familiar with the debit and credit rules. So we will increase the asset, which is debit asset 20,000, and then credit the revaluation reserve OCI because it goes to OCI instead of P&L by 20,000, right? So this would be the entry on 1st April 2001. From April 2001 to April 2002, the asset value went down by 25,000, right? The asset value went down by 25,000. So what would be the entry on April 2002? The entry on April 2002 would be, first of all, we will reduce the previous positive balance. So if you remember, this was 0.3 from previous slide, 0.3 from previous slide. So what happens there is you decrease the revaluation reserve first by 20,000 because you only have 20,000 in the revaluation reserve. And then the remainder goes to P&L. Because this is a loss, there is a total loss of $25,000. So the remainder 5,000 will be charged in P&L. And then you also decrease the asset by 25,000 total. So of course, debits are always going to be equal to credit. So the entry has to balance, right? The entry has to balance. Then from April 2002 to April 2003, the assets value went up by 15,000. The asset went up by 15,000. So of course, what you will do is debit asset by 15,000. And then what will happen is, so the previous loss will be reversed. But it has to be maximum of 5,000. It cannot be, we cannot charge, so this should, this should be 10,000. There is a typo here. This should be 10,000 instead of 15,000. But this here P&L should be 5,000. It cannot be 6,000 or 10,000 because maximum loss recorded in P&L was 5,000. So this is basically, this is 0.2 from previous slide. So you credit P&L by 5,000 and the remainder gain would go to revaluation reserve OCI of $10,000. Right, so I hope 0.2 and 0.3 from previous slide are clear using the examples here. Moving on to depreciation. HKAS 16 requires depreciation to be charged on PPE, right? So depreciation charge for each period will be recognized in P&L. As we know, it's always in the income statement. And then the accumulated depreciation is reduced from the asset value to come at the carrying amount. The two most common depreciation methods are straight line method and reducing balance method, as we know. These are two most common methods. The depreciation of an asset begins when it is available for use, right? As it says here. And then it ceases if you have sold the asset, or if the entity has decided to sell the asset, because then you will move from HKAS 16 to HKFRS 5, right? So, and this is very common. Tested in QP sometimes. So whenever you are reading questions, if there's a question on PPE, you must be careful in reading the questions, because reading questions is very important in professional accounting exams. So a few things to be highlighted here is depreciation begins when the asset is ready to be used, and the depreciation ceases when the entity has classified the asset under HKFRS 5, or you have sold the asset, or the entity has sold the asset and it's no longer on the balance sheet or the statement of financial position of the entity. Then we have residual value. Of course, residual value is just an estimate of what the asset can be sold, right? And then we have useful life of an asset, which is basically the life of the asset. If there is any change in residual value or useful life, that is accounted for as a change in accounting estimate. So this is change in accounting estimate under HKAS 8, right? So you go to HKAS 8 for accounting policies and change in accounting estimates and errors. So this would change in residual life and useful life would be change in accounting estimates, and it happens in real life, in practical life. Entities may change the residual value or the useful life of the asset. Let's look into some disclosures as well. So the financial statements shall disclose for each class of PPE the measurement basis, that is either cost or revaluation model, right? So that's the measurement basis. Depreciation method used, so it's either could be SLM, straight line method, or DDB, double declining balance method, or reducing balance method. Then the useful life or the depreciation rates used, right? So it's again a useful information for investors. Then you would then as an entity, you may also disclose the gross carrying amount and the accumulated depreciation aggregated with accumulated impairment losses. Because if you look at the balance sheet or statement of financial position and the annual reports, they just give you numbers, but there will be notes as well. And then those notes are basically disclosures. And then as an entity, you may also provide with the reconciliation of carrying amount at the beginning and the end of the period. So there are always 2 years of balance statement of financial position in the annual reports, in the current year and the prior year, right? So if you go to the notes of PPE, the PPE reported in their financial statements, in the company's financial statements, there is going to be a note, and then that note will give you all these numbers over there. So, and that note will give you the complete reconciliation from beginning balance to the ending balance of PPE. I hope you found this video helpful in your revision of HKAS 16. If you find this video helpful, please give it a thumbs up and subscribe to my channel for more videos like these. Thank you very much.